Hey everyone, welcome to another episode of Signal or Noise. This is episode 14. Charlie Bilello here, and joining me as always, Peter Mallouk. Peter, I want to start out with talking about your journey as an investor and really what movie would kind of capture that. And for me, definitely There Will Be Blood. I don't know if you've seen this movie, one of my favorites,
One
Daniel
of the best
Day-Lewis.
movies of all time.
Just an awesome movie. And what do I mean by this? Well, as an investor, it's going to be a bloody experience. Most of the time, as we'll talk about, you're going to be in a drawdown, and we're in one today. It's gone on for a lot longer than recent investors are used to. As you can see here, we had a long period where the market didn't have a drawdown for longer than a year, and oftentimes it was hitting all-time highs very frequently, as we'll show in a bit. But we're now 1.8 years into it. So in 2 years will be this January if we don't hit a new all-time high. Now, the drawdown wasn't as big as the two previous big bear markets in terms of 2007 to 2009 and 2000 to 2002. But whenever you have this long period of a drawdown, inevitably investors are going to be asking the question, are we ever going to get back to new highs? What should I be doing? Should I be making changes in my portfolio? Does a drawdown mean that the future is going to be worse in terms of returns? And how do you think about drawdowns in general as from an investment standpoint? How do you talk to clients when it's a long time in between all-time highs that were, I wouldn't say it's a huge amount of time, but just something they're not used to, especially new investors?
I think this is really interesting from a psychological standpoint. We know bear markets happen about every 5 years, 20% drop or more. We know corrections, 10% drop or more, happen every 12 to 18 months, and the average correction is about a 14.5% drop. But an interesting, I think I'm probably isolated in this take, is I actually think what we're going through now for investors is worse. So when you go through COVID, we had that 34% drop, fastest 34% drop in history, but you're just so stunned. You're so focused on the external threat. At that point, it was COVID. But whenever you have a huge drop, there's always an external threat. There was the housing collapse. Am I going to keep my home? Is the economy going to even function? Is the banking system going to function? 9/11, what other terrorist event is coming? So you're preoccupied with this other force that created that event. And the economics, the market's moving so fast, you're shell-shocked. So you get through it, but you're traumatized. There's blood everywhere, but you've gotten through it because you kind of didn't have time to react. Investors have a much harder time with this long slog. Here we are, almost 2 years of nothing. It reminds me of 2000, 2010, the S&P 500 earned zero. And everyone's like, well, why is all my money not in emerging markets and overseas? And here you can say, well, why am I in stocks at all? 1.8 years, no return. But that's how the market works. Nothing's ever the same. 08, 09, extremely traumatic, very long recovery. COVID, extremely rapid, very sharp recovery. Here, not nearly as deep a drop, but it's day after day, week after week, month after month, going on 2 years now. Very challenging. It tests the patience of investors.
Right. So if we don't hit an all-time high before the end of the year, we're going to break this streak that we've had running since 2013, where the S&P has hit an all-time high every single year. But as you can see from this table here, we've had many periods where there was a number of years without an all-time high. So this is not anything unusual. It's just unusual as compared to recent history. So the other period, as you can see, that stands out here is during the 1990s, right, where it hit an all-time high pretty much every year. And from 2001 to 2006, then no all-time high. So we don't know. We could go back to all-time highs, of course, next year, and this chart will look different. But I think the big question for investors in terms of drawdowns is there any predictive power? What a lot of people are asking me, especially when you have a correction. We recently had a correction of 10%. Markets rallied a lot since then. So that's almost been erased very quickly here. But people often ask, well, what does that mean? What does the market do going forward when the market's down 10%, 20%, 30%, 40%? So I went back in time and looked at all of these different scenarios. And the first thing I think that should be important for investors is that percentage of the time you're in a drawdown versus at an all-time high. And this is looking at monthly data, total return data, so it includes dividends since 1928. As you can see here, only 29% of the time is that S&P ending that month at an all-time high, which means the majority of your time as an investor is going to be spent in a drawdown. And that's why I say there's going to be blood, there's going to be a drawdown. That's the one prediction we can make, is there's going to be times of trouble. And we have these drawdowns of varying degrees. So less than 10%, 10 to 20, 20 to 40, greater than 40. And what does the market tend to do going forward, Peter? I think it's pretty interesting. It's so consistent. The market a year later is often higher on average, and not always, of course, but often higher. And the longer that you go from that either drawdown or all-time high, the bigger the returns. And here's the most fascinating thing, I think, that was a shock and a lot of people would be, the bigger the drawdowns. So looking at greater than 40% drawdowns, actually the better the long-term return. So if you have 15 years, 20 years, 30 years, you're a young investor in your 20s, your 30s, even your 40s, and you're not going to be touching that money, it's actually the best thing possible is you have this drawdown, because you're still adding and buying in, and now you're able to buy in at lower prices. And if anything, if there's another table that you should put on your wall, I don't really know what it would be other than this, because you're always going to be in a drawdown. Just remind yourself, right, as an investor, that things are going to be better in the future.
Yeah, I mean, if you're an accumulator, this is really easy. I mean, if you believe the market's going to be here and later it's going to be there, like it's always been throughout history, the longer it can stay down or even negative, that you should be loving that. If you're contributing to a 401k or contributing monthly, like if you're in retirement, if you're the group of people that's withdrawing, shouldn't be at the mercy of the market, right? We shouldn't be selling stocks while the market's down. We should have other assets to be able to do that. Should be a no-lose situation for the long-term investor.
Okay, so we covered that. Is the 60-40 portfolio dead? This is a question that comes up pretty much every year, and people have been talking about this, it seems like, for a long time. And here it is again, another headline. We're not in Kansas anymore. Why the 60-40 portfolio might be dead and what to do about it now. This is interesting to me, because the time to be thinking about a 60-40 portfolio being dead, especially in terms of the 40, and I know you and I were talking about this a lot in 2020, was probably when bond yields were close to zero, right? And so to be saying it now when you have 5% bond yields seems a little strange to me. But first, let's put this in context in terms of the last 7 years and historical returns. The last 7 years now, Peter, bonds have contributed nothing, actually negative, to that 60-40 portfolio. That's really never happened before in history, right? Because bonds always had a decent yield, and 7 years ago they had a very low yield. Today they have a higher yield. That's worked against bonds. But if we look at the stock market in the last 7 years, it's done around 9% a year, and the 60-40, 5%, definitely below average. I think the average is around 9% over the last 50, 60 years, but not terrible, right? So people saying it's dead today is really, to me, is making a statement that either the stock market is dead and or the bond market is dead. And when you hear these things, what do you make of that? It's hard to say. If you're saying both the stock market and the bond market are dead, that's a pretty bad environment for investors. So it's a kind of an
Right.
extreme statement to be making.
I think
So what's your take on this?
you know, when I hear the 60-40 is dead, I mean, I said this, I think 6 years ago on a Jeremy Siegel podcast, talking about how at Creative Planning, we really had moved away from this many years, a decade ago. And a
Mm,
typical person that you would see as 60-40 at Creative might be 70-30 or 80-20. And the reason was, to your point, bond yields were 2%, right? So think about the work that stocks have to do in the 60% of the portfolio to lift up the overall return. Well, if you look backwards at the performance of 60-40, go, oh gosh, over the last 1, 3, 5, 10 years, it's not done great. Well, yeah, yields were 2%. If we look at it going forward, yields are 5%. So now it's much easier for a 60-40 portfolio to outperform. And that headline is just, it's hysterical, in Market Watch and everywhere else, because you've got stocks in a drawdown. We know their returns are better over the next 3 to 5 years when that happens. And you've got bond yields have more than doubled. So that outlook is better. And, bonds are not as confusing as people think. 99% of the return from a bond comes from the income. So you go buy a bunch of high quality 5.5% bonds. Guess what you're going to get? 5.5%. It's going to fluctuate on your investment statement over the next 5 years. But when that bond matures, that's what you're going to get. So probably in the last 15 years, the 60-40 portfolio has never looked better. I don't like it as much as the 70-30. I think you should just have the bonds you need to get through the short run. But boy, getting through the short run looks a lot brighter than it used to, given where yields are.
A few things I think that people should note about the 60-40, and number one would be looking at that red line in the chart here. Take a look at the red line versus the two blue lines, and just much smoother, as you said. That beginning yield is highly predictive, as we'll show in the next chart, of what your future return is going to be. The stock market, not so much, as as we've talked about. It's almost all noise in terms of trying to predict where the stock market's going to go, even 7 years from now. Yeah, most of the time it's higher, but predicting whether it's going to be 0, 5, 10, 15, 20% per year, as you can see, we've seen all of that in the past 50 years. And
Right.
the important thing to understand is, even though it's 60-40, the big driver of volatility in your portfolio and the big driver of returns in the long term are going to be from the stock side. So stocks have actually contributed, I think, around 72% of that 60-40 portfolio's return going back in time. So it's not an even split in terms of stocks are 60%, they're contributing no, they're contributing more, and they're contributing way more in terms of volatility. So where this 60-40 portfolio ends up 7 years from now, we know bonds likely to be much better. They're going to
Yeah.
likely give around 5% per year. How we get there is anyone's guess, right? If interest rates keep rising in the short run, the returns will go down. But over that 7 year period, going to be much better. It's the stock side that we don't really know, right? Is it going to be close to that 10% historical average? Hopefully. Is it going to be less? Is it going to be more? We can't predict that. But important to keep that in mind, that the bond side hasn't looked as good as it does today since 2007. And that's simply because your starting yield is the highest since 2007. We had recently a 10-year go up to 5%. And we look historically, what has the bond market done when the 10-year starts around 5%? Over the next 7 years, it's done over 5% per year. So
Yeah.
pretty simple. The
Yeah.
correlation, 97%. You can't find anything like this in the stock market in terms of predictive power of the future. Bond market, very simple. And last point I want to make, Peter, I think this can't be overemphasized here, is you have to, once again, play the long game as a 60-40 investor, right? Over a 3-month period, 60-40 has been positive 74% of the time. You go out to a year, you're up to 85%. 10 years, there's never been a 10-year period, actually, since 1976 where the 60-40 portfolio has been negative, right, or dead. So if you're betting that it's going to be dead in the next few months, you may or may not be right. If you're betting it's going to be dead in the next 10, 20 years, I think
Yeah.
you're really betting against, as we talked about, progress, innovation, that there won't be earnings growth. And that's probably not a bet that you want to be making, right?
Right. That's an end of the world. That's an end of the world bet.
Awesome. So let's go to a question that a client put out, and we thought this would be an interesting discussion. How should a pension influence your asset allocation? So a lot of people don't have pensions, but there's still people that do. They work for the government and military, different areas. They still get a pension, and often that pension income is pretty substantial when you look at it. And I want to break down an example here and get your take in terms of how they should think about. So we just talked about 60-40, how they should think about that pension income influencing that breakdown. So let's say you have $1 million investment portfolio. This is outside of the pension. You have 60% in stocks, 40% bonds. So 600,000 in stocks, 400,000 in bonds. But you also have this pension when you retire, $100,000 per year. So two questions here, Peter. Number one, when you retire, is your real asset allocation, if you don't do anything, really 20/80? Because that $100,000 pension, assuming 5% return, what you would need is around 2 million in bonds. And does that mean your real allocation is 600,000 stocks and 2.4 million in bonds, bringing looking at that 3 million total? And then therefore, this is the second part of the question, should you then overweight stocks in that investment portfolio to kind of counteract that safety that you already have in terms of that pension income? What are your thoughts?
I think your example is perfect, and I do view the pension as bonds. So that the idea of the bonds is to provide that fixed income you need to cover you for the short run in the event of market volatility. So whether it's a pension or a fixed annuity, we should be counting that income as meeting part of that fixed need and start to use the rest of your capital invest in stocks, not just because we've got the short run protected, but also now our threat is really inflation. And so, especially if you don't have a pension that adjusts with inflation, we need the rest of your money to be more towards equities so we can have the value of those go up over time as the price of entry to Disney World or a cheeseburger at McDonald's goes up. We can see those stock prices eventually follow and be able to protect against that portfolio risk.
So in most cases, you would say that some adjustment should be made. I guess it could go the other way in terms of if you had a real risk averse person, now they don't need to take as much risk because they have this additional income as well. So it does come down also to your risk tolerance. But assuming you have a tolerance for some risk, it makes a lot of sense that, and you're not going to need that, especially if you're not going to need that money. You're going to be leaving it to your heirs, charity, or something else. You could definitely take more risk in your stock portfolio. It should influence. The question would come down to that individual situation. That person, are they going to need that money? What are their goals? What are their objectives? Because that pension income is enormous for most people, and if they want to sleep at night and not see that investment portfolio fluctuate at all, they probably have the liberty to do that, even though it might not be the best
Right.
return outcome in the long run. And this has been a frequent kind of discussion on this podcast, Peter, where the right answer for everyone isn't always what is going to maximize that long-term return. And I think that's a hard point, but I think it's an important point.
Yeah, if we do things based on needs, you get a very different answer than if we do things based on what bothers you and what doesn't bother you, right? I mean, to your point, if somebody's financially independent and they freak out if their portfolio goes down 1%, well, throw everything out the window, right? Throw out asset allocation, best expected returns, financial plan, generational planning, and you just say, look, I can't afford any loss at all without over the short run without freaking out. You're out of the stock market. Everything else doesn't matter. And if you're independent, there's nothing wrong with that, right? If you have all your needs met by your income, whether it's from bonds or pension or whatever, and you don't care about maximizing wealth, then you shouldn't be in the stock market. So really, like you said, you've got to look at this from a variety of angles to get to the right answer for you.
Yep, absolutely. So there's a theoretical, and as we said, for most people, it would be shifting more to the stocks, and then there's the actual individual situation. All right. So let's talk about reading. We haven't done this in a little bit. We did the summer reading. We're in the fall now. And I want to talk about a book that you recommended on the Tim Ferriss podcast. We're going to put a link to that in the show notes. Everyone should check it out. Great conversation there. Did you do a little bit of preparation for that, Peter, knowing there's going to be millions of people listening to that?
No, I mean, Tim Ferriss is an extremely laid back guy.
Oh,
And
interesting.
it was long, meandering questions, very fascinating. Went way longer, way longer than I thought, and I'm glad I went into it ignorant as to how long form it would be. But it was a great experience, a great host.
Okay. Yeah, it sounded like you may have known the question, but that's interesting. It was just a conversation. Yeah.
Yeah.
And so no different preparation knowing
Yeah,
that
he didn't
millions of
ask
people.
anything crazy that we don't hear all of the time. So it was really kind of
Yeah.
an easy conversation.
Good. Yeah. So definitely check that out. We'll have a link in the show notes. And this is the book that you said you've gifted to more people than any other book. Tell us a little bit about Anthony DeMello and awareness.
So Anthony DeMello was a Jesuit priest, I think taught in India, and has a lot of the kind of those Far East principles too. And basically, look, it's a book that if you gave it to me at most points in my life, I wouldn't have got past page 2. It's not like you have to be ready for it and ready to accept the idea of it, which is the premise of the book. I would just say is, get over yourself. You're not as important as you think you are. There's a lot of stuff going on in the world. No one's thinking about you as much as you think about yourself. And so the second you can free yourself of all of this, a lot of the things that we think about, which are the past, which could make us depressed, or we think about the future, which brings us anxiety, and we can just start to focus on ourselves in the present moment. I'm not doing this book justice, but it's fantastic. I recommended that when Tim Ferriss brought it up, and he mentioned that he thought it would be a money book, but it was really this book. And he I feel like every year or so, he's tweets or puts out on LinkedIn this book, as you've got on your screen here, as being a book that really transformed him too. So I give it away to people. I tend to give it away to people over age 40, that you've been through enough that that you're ready to receive the message of the book.
And when you say ready to receive, for you, what was kind of the transformation where, okay, this message kind of started to resonate with you more?
I think that is the more that you have going on in your life, the more chaos around you. And I learned at a very young age, when we had twins, and our twins wouldn't sleep. And so when we took the twins, we would just stay up all night. We'd go through the day as zombies. And of course, then when they're little kids, it's 0809 crisis. So I'm dealing with, creative planning is explosive, wonderful growth, nothing to complain about, a market crisis, two beautiful kids, it's all very positive things, but it's chaos all of the time. And a friend said to me, who has a much, much more complicated life and has overcome a lot more, he said, everything changed for me when I learned to embrace the chaos. And I just remember having that mindset really, really at a young age in my late 20s of just, hey, don't fight the chaos or avoid it, just embrace the chaos. This book is like that at a 10x level. It's just basically saying, like, all of this stuff is going to swirl around you all of the time, and don't fight the storm. Be the calm in the middle of the storm. To just be the calm in the middle of the storm. And so it's just the title, awareness. It's that idea of becoming aware of what's really important, of where you sit in the framework of things, and it really gives you um, a frame of reference to maintain a steady hand through everything.
All
Have you
right,
read
great.
this book yet, by the way?
I have not. Yeah,
Okay.
it's surprising, but yeah. All right, it's on my list now. Definitely, and we'll discuss it after I finish it. So my
And by
book,
the way, thanks for covering me. I haven't read a book in quite a while. It's been at least a month, and so you went and just found one online that I've
went to the
recommended. So
archives.
I appreciate that. I appreciate you doing that.
All good. Yep.
Yeah.
So my book is kind of timely today, as we talked about in the last podcast. A lot of fears about World War and the possibility of that. Hopefully, we never get close to that again. But this is a book, Fall of Giants, one of my favorites. Ken Follett, just an awesome author. It's historical fiction, but talks about World War One from many different perspectives. So there's a story about the Britain perspective, U.S. perspective, Russian perspective, and German perspective. And so it ties all of those stories together. But Peter, the fascinating theme, and a lot of people probably don't know. They kind of know the assassination, led to World War One and what happened there with Austria. But at every turn, and the book kind of chronicles this very well, I think. At every turn, when there was a choice for all of these different great powers at the time to choose between peace and war, every single one of them chose war, which is, kind of, you wouldn't have guessed that, like, playing out game theory. You would have thought they all had so much to lose by going to war with each other, and yet just everything fell into place in the wrong way. So it's a good lesson for everyone to learn. Just a war that really didn't need to happen based on what started it, and probably people don't know too much about it. So I would recommend checking that out, and just show you like how foolish our leaders can be, and
Mm.
the people who have no say in it just get caught up in it, as many people did in all these different countries. So definitely check that out, and timely today. So I want to end with signal or noise. A little bit different this time. We're not going to be talking about markets, but we're talking about a decision that really everyone has to make at some point or another in their life, and that's the decision of buying versus renting. And why is this an interesting topic today? Well, this chart really illustrates it. The premium in terms of buying a home versus renting. So if we're looking at the average price to buy a home in terms of that monthly payment versus renting, it's never been higher than it's been today. It's 52% more to buy a home than to rent. To just give some context to that number, during the peak of the last housing bubble, we had a 33% premium. So far and away higher than that. So before we're going to run through an example here too, in terms of people looking at buying a home today and dispel some myths. But before we get into that, Peter, just general thoughts on this chart. And is there any signal for people potentially looking to buy a home today versus renting?
Well, I think that this is a tough conversation because people get emotional about it. But if you were to put on paper, renting versus buying, in most cases, and I think this would surprise people, you're better off renting and taking the money you save and investing it. But most people, including me, want to own a home and they want to build equity. And I look at it like I think the reason people come out ahead with homes is the forced savings. If you rent, you actually have to have the discipline to take all the money you save from maintenance, insurance, taxes, and everything else and go invest it. Most people aren't going to do that. But if you have a home, most people are going to make their mortgage payment. You start to dive into the principal. The home does appreciate much less than the stock market, but it appreciates. Unlike other investments, it takes money away from you even when it's paid off. Like once you've got a paid off home, you're putting money into maintenance, taxes, insurance, and repairs, so on. So, from an investment standpoint, it's not amazing. Even people in parts of the country where it appears amazing, where their home doubled in 10 years, you still did worse than the stock market in most periods in history, right? So, just purely on paper, like, look, we'd all be better off living in a container, right? that's $80,000, or renting the lowest cost place we can be. But we don't all make decisions that way. So most of us want to own homes, but I think that the people who kind of look down on the renter and say, "Oh, you're worse off, and you're not a good," that's completely not correct. The renter who's saving the difference is actually coming out ahead.
Right. So before we get into that example that may illustrate that, how did we get to where we are today? And I think this chart is kind of amazing that home prices in the U.S. are at record highs and housing affordability is at record lows. And so certainly part of that premium is from home prices just exploding higher, going up over 40% in a very short period of time, and they were already moving higher before that period of time. And if we look at and this is where I would say it becomes a problem. I think you and I would agree. If you can afford that house and it's within your means, you're not stretching, and you're planning on living in it for 15, 20 years, go for it. Right? No question. Who cares what it does? And because
Right.
you're going to be getting enjoyment out of that. And don't look at it as an investment, but you have to live somewhere. You're not stretching. That's fine. Here's the problem for most people today: if they have to buy that home, they have to stretch. If we look at the
That's right.
median housing payment as a percentage of your income, you're looking at 45% of your income. That's way above what most people can handle because it crowds out pretty much everything else. Like,
Mhm.
do you want to go on vacation? Do you want to, as we said, do you want to save money for retirement? You want to do all of this other things. We can't do that and be spending this much on a housing payment. Now, at the same time, and you and I have talked about this, but rents have gone up. Let's not let's not pretend uh, that rents have done nothing over the last few years. They've gone up. They just haven't gone up as much as home prices. So rents have gone up 20 something percent. Been hard for a lot of people. But we're talking about home prices up 45, 50 in a lot of areas. They've doubled, right, in the past few years. Just crazy appreciation. And if we look at the last year, asking rents are actually down. So as incomes are still going up. So it's becoming more affordable each month for someone to rent. And we're not seeing that yet on the buying side, just because, as we've talked about, there's so little supply that's keeping prices up. So I want to run through an example here in terms of making that decision and kind of dispel that myth that people say you're throwing away money if you rent. Okay. So here we go, Peter. And I think a lot of people, when they think of the down payment, we often say 20%. But the reality is, most people put down a lot less than that, especially younger buyers. And if we look at the median percentage in the US, it's around 14%. And younger people actually put down even less than that. But if we're assuming that 14%, and we're assuming the median new home prices, which are around 418,000 right now in the US, we're looking at a 30-year mortgage at current rates, 8%. And you look at this chart here in terms of interest paid, principal paid, what do you notice? What jumps out at you right away from that chart in terms of interest and principal,
That's incredible. Incredible. Nuts. The
right?
difference is nuts on interest.
So people assume, right, you're throwing away money on rent. They're
Yeah.
not taking into account that in the early stages of that loan, so you're planning on living in
Yeah.
that house for 5 years, it's almost all going to interest. Over 90% of that monthly payment is going to interest. And if we look at, this is just breaking it down, this is what the payment would be for that median new home for sale today. I'm saying there's property tax, right? Insurance, PMI, because you're not putting down that 20%. And for the HOA fees, I'm just assuming some maintenance and very minimal, right? As compared to what actually most people would put into a house. So it's not just, right, that mortgage payment, right? And this is the part when people are investing and they're talking about house as an investment, they never talk about these other things, right? The maintenance, the repairs, the insurance, the property taxes, and all of that is kind of disregarded. They're just looking at the beginning home price, the end home price, everything that went on in between, and the other expenses don't count. And when they're looking at that mortgage payment, many people are saying, well, that's building equity. And they're saying that entire amount is going on building equity in the home. And the reality is, in the first few years, if you look at first 5 years of this, if let's say that example today of putting 14% down, you are building equity. So that's good. You're building $17,000 in principal. But look how much you're paying in interest over that period of time. 140,000.
It's crazy.
It's really comes down to actually running the numbers for yourself. Like, take a look at it for yourself. And if you're stretching and try to include all of those other costs and what that monthly payment would be. And if you're spending $1,000 more a month or $2,000 more a month to buy that home versus rent, well, here's what it comes down to. It's likely costing you the benefits of saving early. And this is one of the 10 steps to get to $1 million. Saving early, if you can invest that $5,000, let's say your rent is saving you $5,000 per year versus buying a home, you compound that over time, we know that's going to lead to enormous gains. So don't forget about that part. Now, if you're going to take that rent savings and just spend it, yeah, that's a different story. But assuming it's going to allow you to save, assuming it's going to allow you to take vacations, do other things, I think the idea of it's always a good idea to buy versus rent, particularly today, is probably bad advice.
100%. So you just did an incredible job documenting that. And the thing is, you've got to have the discipline if you're going to rent to save the difference. That's going to be the key here. And despite all of these facts, the reality is most people will be better off buying a home. They'll wind up in a better spot, not because the math works better, but because of the forced savings.
Yep, absolutely. And so just be mindful of that. Run the numbers. Talk to your advisors. It's something they could definitely help you with. And just don't fall prey to that simple notion that you're throwing away money. And we talk about this before, but automating it is the best way to make sure that you don't take that money and spend it, right? All right, Peter, covered a lot of ground there. Thanks, everyone, for joining us on Signal or Noise. If you like the podcast, subscribe. If you're watching this on YouTube, hit that subscribe button. We're available on Spotify, Apple, and everywhere else. And we'll see you next time on Signal or Noise.